Broad market index funds tracking the total U.S. stock market, or the S&P 500, have returned an average of 8 to 10% annually over every meaningful long-term period in American market history. Inflation over those same periods has averaged roughly 3%. The real return, the return above inflation, has been approximately 5 to 7% annually. That is not a coincidence or a historical anomaly. It is a structural feature of how equity ownership works. When you own a share of an index fund, you own a fractional piece of hundreds or thousands of businesses. Those businesses sell goods and services whose prices rise with inflation. Their revenues go up when prices go up. Their profits, over time, reflect the higher nominal value of everything they produce and sell. The companies inside a total market index fund are not passive observers of inflation. They are participants in it. Their pricing power, their ability to raise prices as input costs rise, is what makes equity ownership one of the most powerful inflation hedges ever invented. The critical thing to understand about this investment is the time horizon requirement. In any single year, or any short period, the stock market can move dramatically in either direction for reasons that have nothing to do with inflation. The S&P 500 dropped 34% in a single month in early 2020. It dropped almost 19% in 2022. In both cases, it recovered and moved to new highs within a relatively short period. The inflation-beating property of broad index funds is not a short-term feature. It is a long-term structural feature that requires staying invested through volatility rather than selling when the number on the screen goes down. Wealthy people who hold index funds for decades almost universally come out dramatically ahead of inflation. People who sell during downturns and try to time re-entry rarely do. The second investment is one that wealthy people have understood for generations and that regular investors increasingly have access to in multiple forms. Real estate in markets where supply is genuinely constrained beats inflation through two simultaneous mechanisms that no other common investment replicates as reliably. The first mechanism is price appreciation. In markets where population growth, geographic constraints, or regulatory barriers limit the ability to build new housing, property values tend to rise at rates that track or exceed inflation over time. When the cost of building materials rises, when labor costs increase, when everything in the economy gets more expensive, the replacement cost of existing housing rises with it, and that rising replacement cost provides a floor under property values that cash and bonds simply do not have. The second mechanism is rent. If you own a rental property, your income from that property is not fixed the way a bond coupon is fixed. Rents move with market conditions. As inflation raises the cost of everything including housing, rents in supply-constrained markets tend to rise. Your income from the property adjusts to the inflationary environment while the underlying asset simultaneously appreciates. You are collecting two forms of inflation protection from the same asset simultaneously. The barrier to direct real estate ownership, the down payment, the management requirements, the concentration risk of owning a single property is real and meaningful. For investors who want real estate exposure without direct ownership, real estate investment trusts known as REITs provide access to diversified portfolios of income-producing real estate through a standard brokerage account. Publicly traded REITs are required by law to distribute at least 90% of their taxable income to shareholders, making them income-generating inflation hedges accessible to any investor with a few $100s and a brokerage account. Let me show you what the difference between beating inflation and losing to it actually looks like in a real person's financial life, because I think the abstract percentages do not fully capture the stakes of this decision. Sarah is 36 years old. She has $200,000 in savings that she built over 8 years of disciplined work. She is trying to decide what to do with it. Version 1 of Sarah puts the $200,000 in a high-yield savings account earning 4% annually, slightly above the expected inflation rate of 3%. After 10 years at 4%, her balance is $296,000. Her real purchasing power gain after 3% annual inflation is minimal. She has essentially preserved her wealth, not grown it. Version 2 of Sarah puts 50,000 in her emergency fund earning 4% and invests the remaining 150,000 across a broad market index fund and a REIT portfolio, earning 8% annually. After 10 years, her invested portion has grown to approximately $323,000. Her total, including the emergency fund, is approximately $398,000. In real terms, adjusted for inflation, Sarah version 2 has meaningfully grown her purchasing power while Sarah version 1 has barely maintained hers. Same discipline, same starting point, same decade, one decision about where the money lived. The outcome difference is not trivial. It is the difference between financial progress and financial stagnation dressed up as safety. The third investment is the one that most people have heard of but few fully understand, and it is the most direct and explicit inflation hedge the United States government offers to individual investors. Series I savings bonds, commonly called I bonds, are government-backed securities whose interest rate is directly tied to the consumer price index. When inflation rises, your I bond interest rate rises with it. When inflation falls, the rate falls, but it never goes below zero, meaning you cannot lose the purchasing power of your principal through deflation. The government guarantees both your principal and a real return above inflation. This is structurally different from every other investment on this list. Index funds beat inflation on average and historically, but they can underperform inflation in any given year. I bonds are designed by law to match it. The limitation of I bonds is their purchase cap. Individual investors can purchase a maximum of $10,000 in I bonds annually through treasurydirect.gov. That ceiling limits their role in a larger portfolio, but for the portion of your savings that you need to be both safe and inflation protected, I bonds are arguably the most efficient vehicle available. Treasury inflation protected securities, known as TIPS, serve a similar function, but without the purchase cap and with the ability to hold them in standard brokerage accounts and retirement accounts. TIPS are government bonds whose principal value adjusts upward with inflation. As inflation rises, the principal rises and your interest payments, which are calculated as a percentage of principal, rise with it. For the conservative portion of an investment portfolio, the portion that needs to be stable and accessible, TIPS and I bonds are the most direct inflation protection available, and they carry the full faith and credit of the United States government behind them. Before we get to the fourth and fifth investments, I want to pause on something that gets underemphasized in almost every inflation conversation I've seen in financial media. The most powerful inflation hedge available to most working Americans is not an external investment at all. It is their own earning power. A person who consistently develops skills that increase their market value, who negotiates their salary at regular intervals, and who positions themselves in industries or roles where income growth keeps pace with or exceeds inflation is protecting themselves from inflation's effects more directly than any portfolio allocation can. I raise this not as a substitute for the investment strategies in this video, but as a complement to them. The combination of continuously increasing earning power and consistent deployment of that income into inflation-beating assets to what produces real, durable wealth over a decade. Neither one alone is as powerful as both together. Skills compound just like interest compounds, and the person who comes out of this decade ahead financially is almost always the person who worked on both simultaneously, rather than waiting to earn more before they started investing or investing without attention to whether their income was keeping pace with what the economy was demanding. The fourth investment is one that wealthy people in particular have used for generations to generate income that rises with inflation rather than staying fixed as bond income does. Dividend growth stocks are shares in companies that have not only paid consistent dividends, but have raised those dividends annually for extended periods. The S&P 500 Dividend Aristocrats Index, for example, tracks companies that have raised their dividends for at least 25 consecutive years. These companies have maintained and grown their shareholder payments through multiple recessions, multiple inflationary periods, multiple market crashes, The reason dividend growth stocks are particularly powerful as inflation hedges is the mechanism behind the dividend increases. When a company raises its dividend consistently over decades, it is demonstrating that its business generates increasing amounts of cash over time. That increasing cash generation reflects the company's ability to raise prices, expand its customer base, grow its revenues in nominal terms. A company that raised its dividend by 8% last year, while inflation ran at 3.5%, handed its shareholders a real income increase of 4.5%. Their income went up in real terms, not just on paper. Bond holders, by contrast, received the same fixed coupon payment they agreed to when they bought the bond, now worth less in real terms than when they received the first payment. The practical way to access dividend growth stocks is through ETFs specifically designed to track dividend growth indices. These funds hold diversified portfolios of dividend-growing companies, pay quarterly income that tends to rise over time, and provide equity appreciation on top of the income stream. For investors who are approaching or in retirement, the combination of rising income and equity appreciation from dividend growth stocks is arguably the most effective inflation protection available without taking on speculative risk. The fifth investment is the one most people either overlook entirely or treat with unwarranted suspicion because commodities as an asset class have a reputation for volatility that obscures their inflation hedging. Properties when accessed in the right form, commodities, oil, natural gas, agricultural products, metals, timber, are the raw materials of the economy. When inflation rises, it is often because the cost of these raw materials is rising. Commodity prices are not just a symptom of inflation, they are frequently a direct cause of it, which means owning commodities during inflationary periods is owning the thing that inflation is made of. The challenge with direct commodity ownership, buying oil futures or gold bars, is that it is complex, potentially expensive, and requires active management that most individual investors are not equipped to handle effectively. The more accessible and in many ways more effective route to commodity inflation protection is through energy infrastructure companies, pipeline operators, storage facilities, liquefied natural gas terminals. These businesses charge fees for moving and storing energy commodities. Their revenues are often contractually linked to the volume of energy moving through their systems, and those contracts frequently include inflation adjustment clauses built directly into the pricing structure. They are not pure commodity plays, but they participate in the inflation sensitivity of commodity markets through fee structures that rise with the inflationary environment while generating consistent income streams that most pure commodity investments do not provide. Master limited partnerships and energy infrastructure ETFs provide access to this sector through standard brokerage accounts and have historically demonstrated strong performance during periods of elevated inflation. They are not appropriate for every investor, and they carry sector concentration risk that requires balancing against other holdings. But as a component of a diversified inflation-beating portfolio, they provide exposure to an asset class that tends to perform precisely when inflation is most damaging to the rest of a portfolio. Let me make this practical because a list of inflation-beating investments without a framework for how to actually allocate among them is just a collection of interesting ideas that never gets implemented. The allocation that makes sense for any individual investor depends on their time horizon, their income stability, their existing holdings, and their psychological tolerance for volatility. But here is a framework that captures the core logic for a typical investor in their 30s or 40s with a long time horizon. The foundation of the portfolio, somewhere between 50 and 70% depending on risk tolerance, belongs in broad market index funds. This is the engine. It provides the long-term real returns that have beaten inflation across every extended historical period while requiring the least active management and carrying the lowest fees. A meaningful allocation, somewhere between 15 and 25%, belongs in real estate through either direct ownership or REITs depending on whether you want the concentration and leverage of a physical property or the diversification of a REIT fund. Real estate's dual mechanism of appreciation and income makes it an essential component of a portfolio designed specifically to beat inflation. A smaller allocation, 5 to 10%, belongs in explicit inflation protection instruments like bonds and tips. This is not the growth engine of the portfolio. It is the insurance policy, the portion that maintains purchasing power in the scenarios where even equities struggle against inflation in the short term. A targeted allocation to dividend growth stocks, somewhere between 10 and 15%, provides the income component that rises with inflation and gives the portfolio a cash flow profile that becomes increasingly valuable as you approach the years when you will begin drawing from it rather than building it. And a modest allocation, 5 to 10% maximum, to energy infrastructure or commodity-linked investments provides the portfolio with direct exposure to the raw material economy that tends to outperform specifically during the inflationary episodes that can temporarily underperform every other asset class. Together, this framework gives your money multiple mechanisms for beating inflation simultaneously. Different assets that respond to inflationary pressures through different structural mechanisms, reducing the risk that any single mechanism fails you in any particular market environment. Here is something I need to say directly before we close, because it is the thing that defeats every investment strategy, including all 5 I just described. Panic selling. The single most reliable way to turn an inflation-beating investment portfolio into an inflation-losing one is to sell the investments when they go through periods of underperformance, collect the losses, move back to cash, and wait for things to feel better before reinvesting. Every one of the 5 investments I described will go through periods where it feels like the wrong choice. Index funds will drop 30% in a bear market. Real estate will stall or decline during rising rate environments. Bonds and tips will feel less exciting than whatever is performing well in any given year. Dividend stocks will cut dividends during severe economic contractions. Energy infrastructure will get hammered during commodity price collapses. None of these events change the long-term structural case for any of these investments. They are the short-term turbulence that the long-term investor has to remain seated through in order to collect the long-term returns. The investors who beat inflation over a decade are not the ones who found the best performing asset in any single year. They are the ones who built a diversified portfolio of structural inflation hedges and stayed in it through the years when it tested their conviction. Conviction, in investing, is not a personality trait. It is a product of understanding why you own what you own deeply enough that short-term price movements do not override the long-term logic. Here is the honest truth about what this decade is going to do to people's finances. The people who come out of the next 10 years ahead are going to be the people who stop treating inflation as background noise and started treating it as the primary threat to their purchasing power that it actually is. They are going to be the people who move beyond savings accounts and into assets that participate in the inflationary economy rather than sit outside it collecting a rate set by a bank. They are going to be the people who built diversified portfolios of the 5 investment types I described today and held them through the volatility with a understanding that short-term pain and long-term gain are not opposites. They are features of the same system. The people who are going to fall behind are the people who do nothing different, who look at their savings account balance, feel secure because the number is stable, and spend the next 10 years watching that stable number buy progressively less of the world. Inflation does not announce itself dramatically. It does not send a letter saying it is coming for your purchasing power. It just shows up quietly in grocery receipts and utility bills and insurance premiums and rent. Notices until one day you look at what things cost and what your savings can buy, and the gap between those two numbers is large enough to matter for the rest of your life. You now know 5 specific investments that are structurally designed to close that gap rather than widen it. The only question is which one you are going to start with.